funds or hot stock tips.
No complex models.
Nope. Just what do you own and why? He's not after what you think is cheap based on some analysis. He wants to know what you personally believe in enough to put your own money into, your actual skin in the game.
Right, your real commitment. And it's pretty wild how often that commitment seems to be, well, missing, even where you'd least expect it.
Like where?
Well, there is this Morningstar study. It found that half of all U.S. mutual fund managers don't invest a single penny of their own cash in the funds they actually manage for other people.
Wait, half. That seems, I don't know, counterintuitive, almost hypocritical.
It feels that way, doesn't it? But the source suggests maybe it's less about hypocrisy and more just common. This gap between professional advice and personal practice, it happens more than you'd think.
And it's not just finance, right? You see it in other fields, too.
Definitely. Think about doctors. There was this really powerful essay back in 2011 by Dr. Ken Murray, How Doctors Die.
Oh, I think I remember hearing about that.
Yeah, he's a professor at USC. And he found that when doctors themselves are facing, the end of life, a terminal illness, they often choose very little medical treatment.
Really? Less than they might recommend?
Often, yeah. They tend to opt for palliative care, comfort, managing symptoms, focusing on, as he put it, going gently, often at home with family. It's quite a contrast to the sometimes very aggressive do-everything approach they might offer patients.
Wow. So why the difference? Why do they choose one path for themselves and maybe suggest another for others?
Well, that really gets to the core of it. For these incredibly complex, deeply emotional issues, end-of-life care, big financial choices, the source argues pretty convincingly that there just isn't one universal truth. There's no single right answer that fits everyone.
Okay, so it's more personal.
It's entirely personal. It's about what works for you, for your family, what lets you feel okay, what helps you sleep at night. These big decisions, they're not just numbers on a page.
They're made around the dinner table, you mean?
Exactly. Often driven by wanting to avoid regret later or protect your family, not just chasing the absolute highest return possible on paper.
So, okay, if that's the case,
Right.
what does financial success really even look like then? Because it sounds like it's not just about piling up the most money.
Precisely. The philosophy we're really digging into today isn't just about getting rich or beating the market. It's something more fundamental. It's the pursuit of independence.
Independence, okay.
Yeah, the legendary investor Charlie Munger, he put it so well. He said, "I did not intend to get rich. I just wanted to get independent."
That's a really interesting shift. It's not about the dollar amount, but the freedom it buys you.
Exactly. The freedom to choose, to control your own life, your own time. That's the real prize.
So independence means what? Like being able to walk away from a job you don't like?
That's a huge part of it. The source defines it as doing only the work you like with people you like at the times you want for as long as you want. And they share this really powerful story about the author's dad. He was an ER doctor, high stress, obviously, worked in it for 2 decades. And then one day, at age 40, he just quit.
Just like that.
Just like that. Because he could. And that ability, that power to just wake up and decide, okay, I'm changing things starting today, completely on your own terms whenever you feel ready. I mean, that feels like the ultimate financial goal, right?
Yeah, the source called it the grandmother of all financial goals. I like that.
Me too. And here's the kicker.
What's that?
Achieving that kind of freedom, that independence, it doesn't necessarily require a huge income like an ER doctor's.
Really? So how does it work then?
The real driver, the engine behind independence, isn't so much your income level, but your savings rate, how much you're putting away.
Okay, savings rate. Makes sense.
And once you're earning, a decent living, what mostly controls your savings rate isn't getting a raise, it's your ability to keep your lifestyle expectations from constantly inflating, keeping things in check.
Avoiding lifestyle creep.
Exactly. Which leads to this idea they call stopping the goalposts.
Stopping the goalposts.
Yeah. The author and their spouse, they had rising incomes for over 10 years, one in finance, one in healthcare, but they consciously decided to pretty much stick with the same moderate lifestyle they had when they were just starting out.
So, decent apartment, decent car, decent food. Nothing too fancy.
Right. They found it comfortable. They just didn't feel the need to constantly upgrade everything as their paychecks got bigger. They essentially said, okay, this is good enough. Let's stop moving the goalposts for what enough means.
And because they did that.
Because they did that, almost every extra dollar they earned from raises didn't just get absorbed into spending more. It went straight into savings. into their independence fund, as they call it.
So their savings rate just kept going up and up.
Continuously. It wasn't about being stingy. They just weren't particularly motivated by more stuff. Their aspirations kind of plateaued in that area, so they just let the goalposts sit there.
That takes discipline, though.
It does, but think about the psychological benefit. By choosing not to constantly upgrade, you sidestep that whole exhausting game of keeping up with the Joneses.
Yeah, that relentless comparison trap.
Exactly. Nassim Taleb, the author, has this brilliant line: true success is exiting some rat race to modulate one's activities for peace of mind.
Peace of mind. That's a huge win, often totally overlooked.
Enormous. And it frees you up to make decisions that might look, let's say, irrational if you're only looking at spreadsheets.
Okay, like what kind of decisions?
Well, take their choice to own their house outright. No mortgage.
No mortgage. But interest rates have been so low for ages. Financially, that seems questionable.
Oh, they totally admit it. The source says flat out, on paper, it was probably the worst financial decision they made. Any advisor would say, leverage that cheap debt. Invest the difference in stocks for higher returns.
Right. Standard advice.
But for them, it wasn't about the math. It was about feeling secure.
Yeah.
Independent. Getting rid of that monthly mortgage payment gave them this incredible sense of freedom that they valued way more than potentially higher, but also less certain, investment gains.
So it comes back to that choice. Do you want to be happy, or do you want to be technically right, according to the spreadsheet?
Exactly. And they chose happy, or maybe secure. Another example. They keep a really high percentage of their assets in cash.
Cash, like just sitting there.
Yeah, something like 20% of their investable assets outside of their house value, just cash. Which, again, from a pure investment return perspective,
It's hard to defend. You're losing out on potential growth.
totally indefensible on paper, but they don't see it as idle cash losing to inflation. They call it the oxygen of independence.
Oxygen of independence. How so?
Because having that buffer means they are never, ever forced to sell their growth investments, their stocks, at a bad time just because some unexpected large expense pops up.
So it protects the long-term investment.
Precisely. It lets the compounding keep working. Remember Charlie Munger again. The first rule of compounding is to never interrupt it unnecessarily. Their bedrock belief is that everyone eventually faces some huge expense they didn't see coming.
A medical bill, job loss, roof caves in.
Something. And that cash reserve makes it much, much more likely they can ride out that storm without having to wreck their long-term investment plan. It lets compounding do its magic over decades.
Okay, so this focus on independence, on sleeping well, on avoiding forced selling. How does that shape their actual investment portfolio? What do they own?
It's led to, well, simplification. The author mentions that back in their 20s, they used to be an active stock picker, holding maybe 25 different individual stocks.
Trying to beat the market.
Yeah, the usual goal. But now they own only low-cost index funds.
It's just index funds,
Yeah.
like S&P 500 trackers.
Pretty much broad U.S. and international index funds. The shift happened because they came to believe that, for most people, trying to pick winning stocks or time, the market is just low odds.
The odds aren't in your favor.
Right. They figure just consistently investing, dollar cost averaging, into a simple, low-cost index fund gives you the highest probability of long-term success.
And the data kind of backs that up, doesn't it?
Yeah, it really does. That stat they mentioned, 85% of large-cap active fund managers failed to beat their benchmark, the S&P 500, over the decade ending in 2019. That's pretty telling.
So it's like trying to become a pro athlete. Some people can do it, but
But the odds are stacked against most of us. So why take on the extra risk and effort if a simpler approach works well?
so their current strategy is just straightforward.
Remarkably so. Invest regularly from each paycheck into those broad index funds. Max out retirement accounts like 401ks or IRAs. Contribute to 529 plans for the kids' college savings.
Yeah, that's it. No complex trades, no chasing trends.
That's pretty much the extent of the effort. It comes from this belief that there's actually very little connection between how much effort you put into investing and the results you get.
Really. Less effort can be okay.
They argue yes, because market returns are often driven by tails, meaning a few really big winners or a few major events account for the vast majority of the overall long-term gains. Trying to micromanage constantly doesn't necessarily help you capture those.
So keep it simple, stay consistent, let compounding work, and have that cash buffer for emergencies.
That seems to be the core strategy, because if you can reach all your financial goals, achieve that independence, without the stress and risk of trying to outperform everyone else, why wouldn't you?
Makes sense. The ultimate goal isn't beating the market.
Nope. The ultimate goal is independence. It's maximizing your ability to sleep well at night. And that, they argue, is the real mastery of the psychology of money.
Wow. So this whole deep dive really drives home that there isn't just one right way to handle your money or your life, really.
Absolutely not. We saw it with Gottsman's question, with the doctor's personal choices, with this family focusing squarely on independence. It's all about how deeply personal values and priorities shape everything.
Yeah, the path to feeling financially secure, it isn't always about chasing every last dollar or maximizing returns on paper.
Often, maybe more often, it's about finding what genuinely gives you peace of mind, what allows you to live life on your own terms.
It comes back to that quote from the source. No one is crazy. People do things that make sense to them, given their own experiences and goals.
Exactly. So, as we wrap up, maybe the question for you listening is, what really stood out to you from this look at the psychology of money? And how might your own definition of financial success, your own path, look different from what the traditional advice might say? Welcome to another deep dive. Today, we're plunging into a topic that really touches everyone: how we navigate financial decisions. We often look for the right answers, don't we? But what if, maybe, the best approach comes from somewhere totally unexpected, like, say, medicine? Yeah, we've got some really fascinating material here for this deep dive. Excerpts from a text that, well, it promises to tie together key lessons for making better financial choices. So our mission today is to unpack these insights for you. And we're going to focus particularly on this surprising historical story that really illustrates the dangers of just being told what to do, especially with your personal journey.
It's really compelling, actually, how this source kicks off with something that seems totally unrelated, an old anecdote. But it just perfectly sets the stage for this critical discussion about autonomy, about decision-making, and what it actually means to be well-informed, whether that's health or finance.
Okay, let's get into it then. Because to really get the author's point, we need to go back, way back, to 1931, and specifically to a dentist appointment that just went horribly tragically wrong. So, picture this. 1931, a man, Clarence Hughes, he's in agony, terrible toothache. He goes to the dentist. The dentist uses what they called back then crude anesthesia. So Clarence wakes up hours later. The toothache is gone, sure, but he finds out he's also missing 16 teeth. And kind of randomly, his tonsils are gone too.
Wow.
Yeah. And then the real tragedy hits. A week later, Clarence dies from complications. From that, extensive surgery he never actually asked for.
And you'd think, okay, medical malpractice lawsuit, right. But his wife's lawsuit wasn't really about that. It was about something, well, more fundamental: lack of consent. Her point wasn't that the surgery itself failed. I mean, that was a risk back then, a known risk. It was that Clarence never agreed to have 16 teeth pulled or his tonsils out, and probably wouldn't have if he'd been conscious and asked.
And the legal side of things in 1931, well, it was pretty murky on this. Consent wasn't exactly clear-cut. The case didn't really go anywhere. And one court ruling sort of summed up the thinking at the time. It said doctors needed, quote, freedom to make the best medical decisions.
Right.
And get this, it added, without such, we could not enjoy the advancement of science.
That ruling,
Yeah.
it really shows you the mindset, doesn't it? The historical medical thinking. For like most history, the doctor's job was just seen as fix the patient. Simple as that. What the patient actually thought about the treatment. Often totally irrelevant. And, it wasn't necessarily doctors being arrogant or malicious. It came from this really deep belief in two things. First, every patient wants to be cured. Okay, seems reasonable. And second, there is a universal and right way to cure them. Now, if you truly believe both those things, then minimizing patient consent, well, it actually follows a certain, albeit strange logic. Sounds jarring now, but back then.
But that's obviously not how medicine works today, thankfully. And the source material we're looking at uses this shift beautifully. There's been this maybe subtle but really profound change in medical schools over the last, say, 50 years. They've moved from just treating the disease toward treating the patient. And that means something fundamental changed. Doctors started laying out the options, explaining the choices. And then, this is the key part, letting the patient decide which way to go.
Yeah, and that massive shift, it was driven by a few things. New patient protection laws played a part for sure, but also the really influential work of a Dr. J. Katz. Katz argued very powerfully that patients, well, they have wildly different views about what's worth it in medicine. What's an acceptable risk for you might be totally unacceptable for someone else, right? Different values, different life situations. So their beliefs, their personal context, it has to be part of the decision.
Yeah, Katz had this quote. It's really powerful, gets right to the core of it. He said, "It is dangerous nonsense to assert that physicians can rely on their benevolent intentions, their abilities to judge what is the right thing to do. It is not that easy. Medicine is a complex profession, and the interactions between physicians and patients are also complex." That last bit. Interactions between physicians and patients are also complex. That feels incredibly important, don't you think?
Absolutely. It's not just the science.
Right. It's the human element.
Exactly. It means even if a doctor means well, their judgment can't just override the patient's autonomy because only the patient really knows what's worth it for them. And this wisdom from medicine, this focus on the individual, it maps so perfectly onto financial advice. Just like a good modern doctor doesn't just dictate treatment, the author of our source material says, look, I'm not going to tell you exactly what to do with your money. They explicitly avoid treating you like that dentist treated Clarence Hughes.
And that distinction is just crucial. It's not saying doctors or financial advisors are useless now. Not at all.
Yeah.
They have huge amounts of knowledge. They know the odds. They know what generally works for most people most of the time. But at the end of the day, you, the individual, you have to decide what's right for your specific, unique situation. Like our source says, there are universal truths in money, sure, but people will apply them differently. And they should apply them differently, based on their own goals, their values, their circumstances.
Okay, so with that kind of groundwork laid, this idea of autonomy and context, our source then gives us a series of short recommendations, but they're not rules, not prescriptions. Think of them more like guideposts, really helpful ones. They're designed to help you navigate your financial life, respecting all that complexity we just talked about, just like a good doctor helps you choose your treatment.
Right. So let's dive into these guideposts. The first one that really jumped out at me, and maybe it sounds a bit, I don't know, counterintuitive, it's humility and forgiveness. The author says you need to really make an effort to find humility when things go right and offer forgiveness or compassion when they go wrong, because they say it's never as good or as bad as it looks.
Absolutely. And it's not just about, being nice to yourself, although that's part of it. It's about really understanding that outcomes, well, they're a mix, aren't they? Your effort, your skill, sure, but also just chance, randomness, luck, and risk. So things go well. Okay, maybe it wasn't all you. Things go badly. Probably not entirely your fault either. Understanding that helps you avoid getting overconfident when you win and beating yourself up too much when you lose, which is, essential for staying sane long term.
That's such a critical point. It changes how you judge yourself, sure, but also how you judge others and who you pick as role models.
Yeah.
Which kind of leads into another big one: less ego, more wealth. The author puts it bluntly, saving money is the gap between your ego and your income. What do you make of that?
Oh, it's spot on. Because wealth itself, often it's the money you don't spend. It's built by resisting the urge to buy something today so you have more options or more security later on. We tend to think wealth is the fancy car, the big house, the stuff we see.
Yeah, the visible stuff.
Exactly. But true wealth is often quiet, invisible. It's accumulated savings, investments. It's about delaying gratification, prioritizing the future over showing off now. It doesn't matter how much you earn, really. If you can't manage that gap between your income and your ego, you won't build lasting wealth.
That really drives it home. Wealth isn't just a number, it's a behavior, a mindset. And speaking of mindset, here's a great guidepost. Manage your money in a way that helps you sleep at night, which is very different from just saying get the absolute highest returns possible, isn't it?
Totally different, yeah. A lot of finance advice focuses purely on maximizing returns.
Yeah.
But this source suggests that prioritizing your peace of mind, that might actually be the best universal guidepost for everyone. It just acknowledges that we're all different. Different risk tolerance, different life stages, different emotional reactions to money swings. If your financial plan keeps you up at night, worrying constantly, even if it looks great on paper, it's probably not the right plan for you. It goes back to treating the patient, not just the numbers.
Makes perfect sense. Your finances should support your life, not cause constant stress. Okay, and for investors specifically, the author highlights the single most powerful tool they have: increase your time horizon.
Time. It really is the magic ingredient in investing, isn't it? It lets compounding work its wonders, turning small amounts into bigger ones. And just as importantly, it smooths out the bumps. Big mistakes. They tend to fade in importance over decades. Market crashes. You have time to recover. The longer you stay invested, the more your results tend to move closer towards what people deserve, meaning closer to the market's long-term average growth. It irons out the volatility.
Gives good decisions time to pay off and bad ones less impact.
Exactly.
Which is a nice segue to another key piece of advice. Be okay with a lot of things going wrong. The source says you can actually be wrong half the time and still make a fortune. How does that work?
Well, it's because in finance, especially in investing, outcomes aren't evenly distributed.
Mm-hmm.
It's often what they call a power law or Pareto principle. A small number of things drive the majority of the results. Think about venture capital.
Right, they expect most investments to fail.
Yeah, they might have tons of investments that go nowhere or even lose money,
Mm-hmm.
but one or two huge winners, Google and Amazon, can make the entire portfolio incredibly successful. So, the lesson is, judge your overall performance, your full portfolio, not individual bets. Fixating on single stocks or single decisions can lead you astray. You might ditch a strategy too soon or think one lucky pick makes you a genius.
It's about the overall average and surviving the inevitable losers to benefit from the big winners.
Precisely. You have to endure the bad to capture the good.
Enduring. That connects perfectly to the next idea. Worship room for error, this gap between what could happen and what you need to happen. That's how you endure, right?
It's such a crucial concept, and maybe a bit counterintuitive again. Our instinct is often to push things to the limit, optimize everything for maximum gain.
Yeah, squeeze out every last drop.
But this guidepost says, no, hold back a bit. Build in a buffer, room for error, having savings beyond your immediate needs, not being fully leveraged. Having flexibility might look like you're being too conservative, like a hedge that costs you potential gains. But it's what keeps you in the game when the unexpected happens. A job loss, a market crash, a global pandemic, whatever life throws at you. And staying in the game is how you let that compounding magic happen over the long run.
Yeah.
So that buffer pays for itself many, many times over. It's not just caution, it's strategic endurance.
I love that framing. Endurance, not just caution. It changes how you think about it. Okay, and then the author wraps up with a couple of ideas that bring it right back to that personal context we started with. Define your game and respect the mess.
Yeah, these are so important for navigating the real world of money. Define your game means understanding your goals, your time horizon, your risk tolerance, and crucially, making sure your actions are not being influenced by people playing a different game.
Oh, that's huge today with social media and everything, seeing people flashing cash or hyping stocks.
Exactly. It's so easy to get caught up in what others are doing. FOMO, right?
Yeah.
Fear of missing out. But if that person is, say, a day trader playing with money they can afford to lose, you're saving for retirement in 20 years. You're playing totally different games. Following their moves could be disastrous for you.
Right. You need blinders, almost. Focus on your own path.
And then respect the mess. This acknowledges that even smart, well-informed, reasonable people can look at the same financial situation and come to completely different conclusions.
Why?
Because, as the source says, people have vastly different goals and desires. What's right for one person is wrong for another. So, there often isn't one single right answer in finance. Accepting that messiness leads to less judgment, both of others and yourself, and probably more effective playing for your own situation.
Wow. Okay, this has been a really, really illuminating deep dive. It shows that financial wisdom, it's not just about the numbers, is it? It's so deeply tied into understanding ourselves, human behavior, our values, even these big historical shifts in how experts think.
Absolutely. And if you connect it all back, that journey in medicine, from a doctor just telling a passive patient what to do to a doctor collaborating with an informed patient, that journey really mirrors the path we should be taking in finance. It's about knowing the general principles, the universal truths, sure, but always applying them with a deep respect for your own individual context, your own specific goals.
Which brings us nicely to our final thought for you, the listener, to maybe chew on. In this world that's just overflowing with financial advice, how do you actively, consciously define the game you're playing? And how do you make sure your decisions truly line up with your goals, your desires as they are now and as they might change, rather than just following someone else's playbook?
And building on that, maybe ask yourself this: how can you intentionally cultivate that room for error in your own financial life? Not seeing it as, just being overly cautious or missing out, but embracing it as the actual foundation. The thing that gives you endurance, the thing that lets that long-term compounding magic truly work for you.
Lots to think about there. Thank you for joining us on this deep dive. Until next time, keep digging for those insights. Okay, imagine this for a second. You fall asleep in, say, 1945. Then you wake up in 2020.
Whoa.
Right. I mean, The shock would be incredible. You'd see this staggering wealth in places like New York, San Francisco, but then, devastating poverty in Detroit,
Mm,
and the prices, homes, college, healthcare. It would make absolutely no sense.
yeah.
And maybe the biggest thing, how average folks think about money, saving, spending. Totally different from back then.
Yeah.
And I bet any story you try to tell yourself about how we got from A to B, it'd probably be wrong. You just couldn't have predicted it. So, yeah, how did we get here?
That really is the essential question, isn't it? If you want to understand the modern consumer's mindset,
Hmm.
even get a handle on where the economy might go next, you really have to trace that journey back.
Okay.
So that's what this deep dive is about. We're going to explore the story, the narrative of the American consumer, really starting right after World War II. We'll link the big events, try to show why we think about money the way we do today.
And why those ideas are so sticky, maybe.
Exactly. Why they're so hard to shake off, even when things change.
All right, let's do it. So we start August 1945. Japan surrenders. New York Times calls it the happiest day in American history. Just pure joy everywhere.
Absolutely. Parades, celebrations.
But then, once the cheering stops, this big question mark starts hanging in the air. What happens now?
And that wasn't just a casual question. It was loaded with anxiety. For policymakers, for regular Americans, everyone.
Because the scale was just enormous.
Think about it. 16 million Americans served.
Yeah.
That's like 11% of the whole population then.
Wow.
8 million were still overseas when the war ended. And almost all of them, barring maybe 1.5 million, were going to be home at a uniform within 18 months.
So the immediate fear was...
Two huge things. Where are they going to live?
Right.
And what jobs they're going to do.
Right.
A lot of people, smart people, economists, genuinely thought, here we go again. Back to the Great Depression. Which, remember, had only really ended 5 years before. That fear was palpable.
And you can imagine, with that depression shadow looming, policymakers must have felt immense pressure. What were the specific things staring them in the face, like the concrete problems?
Well, for starters, housing. Construction basically stopped during the war. Everything went to the military effort.
Sure.
In 1943, they were building fewer than 12,000 homes a month. That's nothing. So GI's coming home. Massive housing shortage.
Okay, so that's shelter. What about work?
Millions of jobs have been created just for the war. Building ships, tanks, planes, highly specialized stuff.
Right.
And those industries, they shut down almost overnight.
Oh.
Boom. Gone. Not like a normal business cycle downturn.
So policymakers were genuinely worried.
Deeply. The Council of Economic Advisors wrote a report for President Truman in 46, warning of, quote, a full-scale depression.
Wow.
There's another memo from 47 summarizing a meeting with Truman, talking about the danger of a downward spiral.
And they couldn't just, export their way out of it?
Not easily. Europe's economy was wrecked. Japan's too. So export markets weren't there. And America itself. Record levels of debt from the war. So massive government stimulus wasn't really an option either.
Okay, so faced with this potentially catastrophic situation, what did they do? What levers did they pull?
This is where it gets really interesting. You see this very deliberate policy choice emerge. Keep interest rates incredibly low.
How low?
Well, the Fed had announced back in 42 during the war that they'd keep short-term rates pegged at 0.38% to help finance the war, right?
0.38. That's
Correct.
basically zero.
Pretty much. And here's the kicker.
Yeah.
Those rates didn't move for 7 years.
7 years.
Yep. 3-month Treasury yield stayed under 2% all the way until the mid-1950s.
So was that just inertia from the war financing, or did they realize, hey, this cheap money could be useful?
That's the key point.
Yeah.
It started as war finance, but it quickly became clear that these rock-bottom rates made borrowing super cheap for houses, for cars, for all the new gadgets people wanted.
So it became a strategy.
An explicit economic strategy, yeah. The historian Sheldon Garin talks about this shift. We went from this wartime culture of save, 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 buy war bonds to actively encouraging people to spend. Cheap borrowing was the engine.
And there were two huge things that really poured fuel on that fire, right?
Absolutely. First, the GI Bill. Just transformative.
How so?
It gave those 16 million veterans access to mortgages like never before. Often zero money down, no interest for the first year, fixed rates so low your mortgage payment could actually be less than rent.
Unbelievable. And the second thing?
An explosion in consumer credit. They started loosening the regulations that had been put in place during the Depression.
Ah, okay.
You get the first real credit card, Diners Club in 1950. Then store credit, installment plans, personal loans, payday loans. It all just took off.
And you mentioned a crucial detail before
Yeah.
about taxes.
Right. Until 1986, the interest on all debt, including your credit card debt, was tax deductible.
They're out. Seriously.
Seriously. Think about the incentive that creates to borrow and spend. It's baked right into the tax code for decades.
Okay, so that really sets the stage. You've got cheap money, easy credit, and after the war, all this pent-up demand. People hadn't been able to buy stuff for years.
Exactly. Factories were making tanks, not toasters.
Yeah.
So households were starved for goods.
Were there other factors boosting this spending wave?
Yeah, there was this sort of hidden productivity gain that came out of the Depression.
How does that work? Hard times make you more productive.
In a way, yeah. The 1930s, tough as they were, forced incredible resourcefulness, efficiency, innovation, just to survive.
Ah, I see.
So you had all these advancements bubbling under the surface, better appliances, cars, phones, air conditioning, wider electricity access. It wasn't obvious during the Depression or the war, but by the 50s, America realized, hey, we're actually really good at making stuff now. We got all these cool new things to make.
And people just went on a massive shopping spree.
Colossal. Give you some numbers. Commercial car and truck production, basically zero from 42 to 45.
Right?
Then, between 45 and 49, 21 million sold. Another 37 million by 1955.
Whoa! And houses.
Same story. Fewer than 2 million built between 40 and 45. Then, 7 million from 45 to 50. Another 8 million by 1955.
It's hard to even picture that scale of building and buying. It's not just economics. It's like the physical landscape of the country changing.
Completely. And think about the jobs. All those returning GIs needed work. What did they do? They got jobs making all this new stuff.
Right.
And they earned good money doing it.
Oh.
The Fed told Truman in 51 that by 1950, consumer spending in home building hit $203 billion. That's about 40% higher than the peak of the war effort in 44.
So the answer to what will the GIs do was basically they'll build the suburbs, fill them with stuff, and buy cars to drive between them.
Pretty much. They were buying stuff with money earned, making new stuff, often helped by cheap loans to buy even more stuff. It was a powerful cycle.
So this post-war boom takes off. What was the kind of social vibe? Was everyone getting rich or was it uneven?
You know, what's really remarkable about that period, roughly 1950 to 1980, is how much the country got richer together.
Shared prosperity. You hear that term a lot.
And it was real then. The gap between the rich and the poor actually narrowed significantly.
How so?
Well, look at the top 1% share of national income. After taxes, it fell from about 13% down to 7% by 1945. And get this, from 1950 to 1980, the real income growth for the bottom 20% of earners was almost identical to the growth for the top 5%.
That's incredible. So people really felt like they were moving up together.
Exactly. And it wasn't just income. It was social leveling, too. Women entered the workforce in much greater numbers. Participation went from 31% after the war to 40% by 1965.
Ever.
Minorities saw gains, too. Eleanor Roosevelt wrote about seeing an African-American reporter at a White House reception in 1945, mixing easily, something she said would have been unthinkable just 12 years earlier.
And lifestyles became more similar.
Yeah, Harper's Magazine wrote in 57 something like, the rich man smokes the same cigarettes as the poor man, uses the same razor. There was this sense of shared experience. But Paul Graham made a great point years later about TV. Back then, there were basically 3 networks. So every night, tens of millions of families, neighbors, were watching the same shows, laughing at the same jokes. What we see now only with the Super Bowl. That used to happen every night. We were literally, as he put it, in sync.
That's a powerful image. And it matters, right? Because we judge our own well-being by looking at the people around us.
Absolutely crucial. For most of that 45 to 80 period, most people saw their neighbors, their co-workers, living lives that felt, similar, or at least understandable, relatable, not wildly different.
So with all this shared growth, how did debt fit in? Were people still scared of it after the Depression?
You'd think so, but no. Household debt actually surged. It increased 5-fold between 1947 and 1957.
Wow. Why?
Well, that new consumer culture we talked about.
Yeah.
All the new things to buy, plus all those new ways to borrow money, credit cards, installment plans, and crucially, those super low interest rates, often subsidized.
But didn't cause problems.
Largely, no. Not then. Because incomes were rising so strongly across the board, people could handle the payments. And remember, people started from a very low base of debt. The Depression wiped a lot out, and wartime rationing and saving had kept borrowing down.
So debt was rising, but income was rising too.
Exactly. Even with that 5-fold increase, The overall household debt-to-income ratio stayed below 60% right up until the late 1970s.
Which is way lower than today.
Oh, much lower. Today it's over 100%, and a lot of that debt was going into homes. The homeownership rate just took off. It was 53% by 45, hit 62% by 1970. Millions became homeowners who couldn't have before.
So this generation just had a different attitude towards debt.
Completely different from their parents.
Yeah.
David Halberstam wrote about this in his book, The 50s. He said they were confident, optimistic. They didn't fear debt like the generation that lived through the Depression. They felt like, the good times were here to stay. The future had already arrived, as he put it.
It sounds like a golden age in a way. America booming, doing it together, debt manageable, but obviously it didn't last forever.
No. The story definitely takes a turn. Around 1973, you start seeing the cracks appear.
What happened in 73?
Well, a recession hit, and it was nasty. Unemployment shot up to levels not seen since the Depression. Inflation, which had been around, suddenly surged and just stuck around. It became persistent.
Stagflation.
Exactly. And interest rates started climbing too. Short-term rates hit 8% in 73. Remember, they were down around 2.5% just 10 years earlier.
And this wasn't happening in a vacuum, right? There was other stuff going
A
on.
lot of other stuff. The hangover from Vietnam,
Right.
riots in cities,
Mm-hmm.
the assassinations of the king, the Kennedys. There was a sense of unease, instability.
Plus, America wasn't the only economic game in town anymore.
Right. Japan's economy was booming, becoming a real competitor. China was starting to open up. The Middle East realized the power it had with oil. The oil embargo hit in 73 too. America's unquestioned economic dominance started to fade.
So those post-war tailwinds were dying down. The economic ride got bumpier.
It got uneven. That's the key word.
But, and this seems crucial, people's expectations didn't change overnight, did they? That idea of shared prosperity, of living like your neighbors.
That's the critical disconnect. The economic reality started to shift, become less equal, less certain. But the cultural expectation, forged in those post-war decades, the expectation that your life shouldn't be dramatically different from the people up the income ladder that persisted.
That idea that, the 50th percentile and the 90th percentile shouldn't live in totally different worlds.
Precisely. That expectation lingered, even as the economic foundations for it were starting to erode.
And this is where that lag you mentioned comes in, expectations moving slower than reality. Because the economy did bounce back in the 80s, right? Morning in America.
Oh yeah, the 80s saw strong growth. Reagan's
Wow.
84 ad wasn't just spin, GDP growth was high. And the 90s too. Bill Clinton, in his 2000 State of the Union, bragged about 20 million new jobs, fastest growth in 30 years.
And the overall growth numbers were actually pretty similar to the 50s.
Roughly, yeah. Total real GDP growth in the 90s was about 40% compared to 42% in the 50s. Pretty close.
So if the amount of growth was similar, what was the big difference?
The big difference was who got that growth. It flowed into, as one writer put it, totally different pockets.
Yeah, inequality.
Berkeley. The Atlantic had a piece showing that between 93 and 2012, the top 1%'s incomes grew over 86%, the bottom 99%, just 6.6% growth.
Wow, that's a huge divergence.
Huge. Joseph Stiglitz pointed out in 2011 the top 1% saw incomes rise 18% in the prior decade. Meanwhile, middle-income folks actually saw their incomes fall, especially men with just a high school degree down 12%.
Okay, so you've got this sharp rise in inequality happening right when people still hold on to those two big post-war ideas. One, you should live kind of like everyone else. And two, it's okay to use debt to get there. That sounds like a recipe for trouble.
It's the recipe for what some people call the big stretch.
The big stretch.
Yeah. As the incomes of that top group soared, their lifestyles pulled away. Bigger houses, fancier cars, private schools, elaborate vacations.
And everyone else is watching this.
Everyone else is watching, first through glossy magazines and TV ads in the 80s and 90s, later amplified massively by the internet and social media, that old keeping up with the Joneses impulse, which only kind of innocent when everyone's income was rising together.
It becomes something much more stressful when the gap widens.
Exactly. It becomes almost impossible to keep up without stretching financially, usually with debt.
Can you give us an example? Make it concrete.
Sure. Think of, like, Joe. He's an investment banker, making, say, $900,000 a year. He buys a 4,000 square foot house, leases 2 new Mercedes, sends his kids to Pepperdine. He can afford it.
Okay.
Then there's Peter. He's a bank branch manager, makes $80,000. Decent income, but nowhere near Joe's. But Peter sees Joe, sees that lifestyle, feels that pressure.
The pressure to keep up appearances.
Right. So what does Peter do?
Yeah.
He takes out the biggest mortgage the bank will give him for a house that's maybe too big. He racks up $45,000 on credit cards. Leases 2 cars he can't really afford. His kids end up graduating with a mountain of student loan debt.
He's stretching.
He's stretching,
Yeah.
trying to maintain a semblance of that upper middle class lifestyle that's drifting further away from his income level.
And the data shows this wasn't just anecdotal.
Oh, the numbers are clear.
Yeah.
The median size of a new American home grew by 50% between the early 80s and the 2000s, even while median wages were basically flat.
50% bigger.
Yeah. And nearly half of new homes had 4 or more bedrooms by the 2000s, up from just 18% in 1983.
People were buying way more house than they used to.
Way more house. And cars, too. The average inflation-adjusted car loan, it more than doubled between 1975 and 2003, went from about $12,300 to nearly $28,000.
Wow.
Plus, the explosion in college costs and student debt we all know about.
So all this stretching meant more debt.
A lot more debt. That household debt-to-income ratio, it climbed from that sub-60% level in the 70s past 100%, hitting over 130% by 2007.
Even while interest rates were coming down in the 90s and 2000s?
Even then, because people were borrowing so much more. And critically, the burden wasn't shared equally. Lower-income households ended up spending a much larger chunk of their income servicing debt, like 14% for the lowest income groups versus 8% for the highest.
That just feels unsustainable.
It was. It brings to mind the economist Hyman Minsky. He talked about how debt crises start. It's that moment when people or systems have taken on more debt than they can actually handle.
The Wile E. Coyote moment.
Exactly. You're running along, everything seems fine, then you look down, realize there's nothing under you, and gravity takes over.
Which is pretty much what happened in 2008.
Precisely. The great financial crisis.
Okay, so 2008 happens, huge crash. Afterwards, people did pay down some debt, deleveraged a bit, and interest rates went to near zero again. Household debt payments are actually lower now relative to income than they've been in decades.
That's true, on average.
But did the policies put in place after the crash fix the underlying problem? Or did they maybe even reinforce some of those inequality trends?
That's a really important and kind of controversial point.
Yeah.
The policies were arguably necessary to stop a complete meltdown, a second Great Depression.
Right. Things like quantitative easing, bailouts.
Exactly. But those policies, while maybe necessary, did tend to benefit asset owners more than wage earners. QE boosted stock prices and real estate helps people who own those things.
Which tend to be wealthier people.
Generally, yes. The Fed stepping in to backstop corporate debt, again, helps bondholders, corporations. Tax cuts over the last couple of decades have also tended to favor higher earners.
So it's not that the policies were necessarily wrong, but they maybe didn't address or even worsen that underlying divergence.
You could argue that. There are symptoms of a system where maybe the economy just works better for some people than others, where success isn't as broadly distributed as it felt like it was in that post-war era.
And why do those old expectations persist? Why do people still cling to that idea of a broad middle class where everyone lives similar lives?
Because it felt good. I mean, really good. For a lot of people, for a long time when it was largely true. That sense of shared prosperity, of common experience. It's a powerful, attractive ideal. It's really hard to let go of something that felt that good, even when the facts on the ground have changed.
And that gap, that disconnect between the expectation and the reality,
Yeah,
that fuels a lot of the frustration we see, doesn't it?
absolutely. Think about the political movements we've seen bubble up. The Tea Party on the right, Occupy Wall Street on the left, Brexit, Donald Trump's election.
Different groups, different proposed solutions.
Totally different groups, often with opposing views, but you could argue they're all shouting in their own way because they feel like stuff isn't working for them.
Within that old framework.
Within the context of that post-war expectation that stuff should work out roughly the same for roughly everyone. When it doesn't, the feeling becomes, this is broken. This isn't the world I was promised or the one I expect.
And that leads to
That feeling of, I don't live in the world I expected, it makes people angry. It makes them think, okay, screw this. Screw the status quo. I'm going to support something totally different, maybe something radical, because this isn't working.
And technology pours gasoline on that fire.
Oh, massively. Social media, Facebook, Instagram constantly shows you curated versions of how other people live, often making the gap seem even larger. Cable news can create echo chambers that reinforce grievances. Benedict Evans made the point that economic outcomes used to be more localized, less visible now. Everything's global, instant, and right in your face. It just intensifies the comparisons and the discontent.
So, looking forward, are we just stuck in this loop? Expectations from the past clashing with the reality of today? Is there a way out?
Well, I try not to be too pessimistic. Economics runs in cycles. Things change.
And there are some positive signs now?
There are. Unemployment is low. We've seen periods recently where wages for lower income workers have actually grown faster than for high income workers, which is a reversal of a long term trend. College costs, once you factor in grants and aid, seem to be stabilizing somewhat.
Yeah, maybe we forget the progress in other areas.
I think so. If you really step back and think about the massive improvements since the 1950s in healthcare, technology, communication, travel, civil rights, opportunities for women and minorities, most people wouldn't actually want to trade today for the 1950s, even with the shared prosperity aspect.
But that core problem remains. Expectations change slowly.
Much slower than reality. That's the central theme, really. Even if we started a new boom tomorrow, a new era of broadly shared growth, that feeling, that deeply ingrained belief that the odds are stacked against everyone but those at the top, that could linger for a generation or more.
So, that feeling of this isn't working, the demand for something radically new right now that might be with us for a while?
It very well could be. It
Hmm.
just shows how the decisions made, the culture created way back after World War II, are still echoing today. History isn't just dusty dates. It's, as the saying goes, just one damn thing after another, all connected. So pulling it all together, this whole journey from that post-war moment of fear and uncertainty to deliberately building a consumer society on cheap credit, finding that amazing shared prosperity, and then watching that fray into inequality and unsustainable debt, it's really baked into how Americans think and feel about money today. Those expectations set back then, they're powerful. They shape our reactions to the economy now, even when the underlying reality is very different.
It leaves you wondering then, what does it really mean when our collective hopes or expectations are out of sync with the economic facts on the ground? How do you, listening right now, navigate that gap yourself? The gap between the life you aspire to, maybe based on those older ideals, and the actual economic situation today. What could help align those things better? And maybe more importantly, what happens personally and for society if they don't align? Something to think about.